and welcome to Banking Transformed, the top podcast in retail banking. I'm your host, Jim Marous, owner and CEO of the Digital Banking Report and co-publisher of the Financial Brand. The financial services industry is undergoing a transformation that's changing customer expectations and disrupted the non-traditional financial players, forced traditional banks to rethink their value proposition. One growing business model is banking as a service, a partnership in which banks and credit unions leverage their charters to enable non-banking institutions to offer financial services directly to consumers. According to recent studies, BaaS is expected to reach $7 trillion in value by 2030. I'm really excited to have my friend Jason Mikula, one of the foremost authorities on the banking and fintech marketplace, on the Banking Transformed podcast. We discuss how banks can unlock new business opportunities and add value, and why BaaS has the potential to transform financial services. Banking as a service has grown in prominence due to the advances in technology that have made embedded banking possible and the rise in fintech firms that require support from traditional financial services companies. But ultimately, the rising demand for banking as a service has been driven by consumers' evolving preferences. Offering financial service such as banking as a service helps banks stay relevant in an increasingly competitive ecosystem, and it allows them to generate new sources of revenue. So welcome to the show, Jason. It has been a while. Somehow we missed each other last week, even though I was in Amsterdam. But before we begin, can you share a little bit about your background to our audience, and also share the definition of banking as a service that is many times misunderstood?
Yeah, absolutely, Jim. Thank you so much for having me. I don't know how we missed each other here in Amsterdam. I guess everyone was like outside excited about the fact there was sunlight and nice weather, and got distracted. Briefly, my background is, I spent about 12 or 13 years in more traditional operating roles, primarily in the consumer lending sector, both in the US and the UK, customer acquisition, focused marketing, and product management. When I relocated here to the Netherlands, I pivoted a bit into more advising and consulting roles. And then, of course, also, writing, publishing, podcasting, having great conversations like this. As far as, defining banking as a service, it's interesting because in some ways, the business model it's describing, or some of the business models it's describing, are not inherently new, right? We've had banks like Bancorp or MetaBank, which is now known as Pathward, sort of operating in this space of partnering with non-banks to offer some amount of payment services or, card issuing for a long time. I think some areas that have changed are the amount of banks that are interested in doing it, the rise of middleware platforms, and perhaps some distribution channels. And I'm sure we'll get into the embedded finance component of this, as we go through the conversation as well. But ultimately, I think of banking as a service as licensed banks partnering with non-banks, and that could be fintechs or it could be non-financial companies to offer some type of financial service that license is required for. So that could be holding deposits, it could be making loans, it could be offering payment capabilities.
So you recently published a great analysis of banking as a service and the impact on traditional banking industry. So what has been, in a little capsulized version, what has been the history and evolution of banking as a service over the years?
Like I said, I think of this as sort of starting in, call it like the mid-aughts, where you had the rise of, frankly, like a small handful of banks that really had niche focus areas, right? So I already mentioned Meta and Bancorp. You've had a number of banks specializing on, the lending side as well. Really, this explodes in sort of the 2010 to 2020 zone. And you can sort of debate the exact start and stop point, but just to make it easy, let's say like that decade, 2010 to 2020, with, post Dodd-Frank, specifically the Durbin Amendment, making smaller banks very attractive as debit issuing partners, the explosion of sort of the first and call it whatever first, second wave of fintech. So, you have Prosper, Lending Club, those were partnering with banks to originate loans. Also around this time, you have the founding of some of the neobanks that are still around today, Chime. And then more recently, I sort of think of it as like the maturation or the rise of native banking as a service players. So that'd be the explosion of banking as a service middleware platforms to simplify integrating with some of these underlying banks that are not necessarily well known for having great technology, and also banks that sort of specifically focus on banking as a service as a business model. So examples of that could include Column, which was founded, quite recently,
right.
Or if you look a little further back, Cross River, I would argue, also falls into that bucket of a bank that was really founded with the purpose of pursuing these, banking as a service business models, operating models.
So what was interesting, we talked about a little bit before the podcast, is that at Money 2020, it was very clear that embedded finance and banking as a service was a key theme throughout the whole event. And actually, a lot of the players on the floor showing their wares really were part of this whole ecosystem. And while banking as a service traditionally was seen as a way to deposit generation, card issuing for a non-banking entity, a fintech usually, the services offered through this model actually have extended quite a bit further, haven't they? And you mentioned a little bit about the lending platforms, but things like buy now, pay later, and other things as well. Correct?
Yeah, I think that's true. I mean, you can always debate or quibble, what should be included or excluded from the definition. Some people would point at issuer processors. So like a Marqeta, a Galileo, some people might call that banking as a service. Some people might say, no, that's not. Similarly, payment orchestration platforms. So in the US, that would be something like Sila, Move, that basically serve as a single point for companies that need to do a lot of money movement, payment processing. Some people might say that should be included. Some people might say that shouldn't be included in the definition. So, I mean, I think sort of where the exact boundaries are, I think definitely open to debate. But to your point, there are a lot of things that go beyond, hey, we're going to hold customer deposits and issue a debit card. That's sort of like, we saw that huge explosion in, call it like 2019, 2020 through maybe late last year, early this year I guess everyone is going to have a debit card because it feels like an easy way to add incremental revenue. I would say, obviously, like all the companies in that sort of space are not necessarily proving to have a viable business model.
Right.
But to your point, there are a lot of capabilities that go beyond just sort of the simple hold deposits, issue debit card.
Yeah, and it's interesting because we had an interview with Alex Johnson last week, and he talked about the fact that some of these niche banks really are not holding their own. It's very hard to get scale, but there is something that's driving this appeal of a banking as a service model. Why are financial institutions, traditional financial institutions in this case, building partnerships beyond their traditional branch network? What is driving this appeal of the banking as a service model?
I mean, I think particularly in the United States, which has a very interesting and I would argue sort of very different history when it comes to bank licensing and bank regulation. In a lot of cases, it's kind of a lifeline, right? I mean, you're talking about growing or relevance outside of a branch network. I know I'm not telling you or probably your listeners anything new here, but the United States, 4,000 plus banks plus another 4,000 or 5,000 credit unions.
Yeah.
If you look at most other developed Western countries, Canada, the UK, France, Spain, where you were in the Netherlands last week, these tend to be very highly concentrated with a handful of banks that dominate the market. The US, very, very fragmented landscape for, reasons we don't need to get into today. But, you need look no further than a chart of the number of physical branches, or the number of licensed banks to realize, despite many policymakers, regulators' best efforts, the trend is towards consolidation. I do not think there's no reason to believe that the underlying economic factors, market factors that are driving that, there's no reason to think that that is going to change. So, what is the appeal of banking as a service? If you're a small community bank, local bank, the number one differentiator asset that you have is that bank charter. Historically, that was paired with the geographic footprint of your branch network. It's 2023. We don't need a physical geographic footprint to do most banking, right? Particularly sort of consumer banking. And so that asset, that physical footprint, which a small local bank could use to differentiate and drive its business, increasingly is devalued. I don't want to say it's completely irrelevant, but it is greatly diminished in its value versus even 5 or 10 years ago. And so if you are that bank in Tennessee or Hawaii or Virginia, and you're having those meetings of, okay, we see the writing on the wall. We still, we have this branch-based business, but how do we continue to grow? You're not going to go out and build new branches, presumably.
Hopefully not. Yes, exactly.
I mean, maybe if you're a city or a Chase, and there's some very sort of strategic areas, maybe. But I mean, if you're a sub 10 billion bank, your strategy is not, we're going to go build a zillion new branches and that's how we're going to grow and capture market share. Banking as a service provides an operating model where they can leverage the charter that they have, hopefully leverage expertise in risk management. So both, balance sheet, obviously, right, also compliance, regulation, and use the asset they have, charter, to grow through partnerships with other companies that need those capabilities and either, do not have / do not want to become a bank. So yeah, I mean, the solution for community banks is it provides an avenue to hopefully continue growing without, trying to lean on an existing branch network.
So what are some of the newer partnerships that you found interesting? What are some of the you mentioned the fact that smaller organizations can do this, and that it's been pretty much the prevalence of smaller organizations that have looked at banking as a service as an opportunity, as you said, to grow without adding branches. What are some of the newer partnerships that you say, that's pretty cool what they're doing?
Well, I'm answering a slightly different question here, but I'll try to get to yours as well.
No,
I mean,
fine.
even since I, first wrote and published this report, which was earlier this year. I mean, it's only
still
halfway
new
through the year. It's still new. Even since then, there have been, substantial signs that there are changes in process in this space, right? You had Fifth Third, which is by no means a small bank,
right,
acquire a banking as a service platform called Rise, and then more recently you had FIS.
Yeah, very recently, exactly.
Very recently,
yesterday.
Have FIS, a stalwart in the core banking and payment processing space, acquire Bond, a banking as a service platform. So there are signs that, what had really exploded in the past 2, 3, 4 years, may or may not be viable, or there may not be enough demand to support the number of players that had entered that banking as a service space.
Yeah, it's interesting. We also interviewed Kurt from Coastal Community Bank, and it's interesting when you peel back the layers of some of these. Some of the things they brought up is their willingness to build partnerships and also let them go if they're not working. But when you peel back the layer of their partnership with One, which was a few years ago, and then the acquisition of One by Walmart, it's a really interesting story where you say, this very modest-sized financial institution could end up with multi-million new relationships, even though it's one step removed. That's kind of a neat opportunity. It's when you look at this, it really is a brand new business model that provides great growth potential, while there are some, pits and perils to it as well. But, one of the elements that, some of the early players did not really have to pay as much attention to because it was a new model and there wasn't a real format to it. And they were also many times partnering with new fintech firms that were just looking for any partner. It's the need to transform the back office for what is becoming the future of banking. What are things you're seeing in the marketplace as to how a traditional bank must rethink their back office to be able to play in this expanding world of providing services one step removed in some cases?
Yeah, I mean, I think it definitely has the potential to represent an increase in complexity, right? I'll try to do this without naming anybody specific.
Right.
But you can imagine it's like, okay, let's say I am the underlying bank partner. It's entirely possible that a single bank could have relationships with multiple middleware platforms, as well as direct relationships with a number of fintechs or consumer-facing companies. So potentially, single licensed bank, ultimately, and I have to admit, I have not had time yet to fully read the updated third-party guidance that was released, interagency guidance on third-party risk management. I haven't read the whole thing yet. But ultimately, the bank is responsible for the regulatory risk of those relationships, whether it's, through a BaaS platform intermediary or a direct relationship. So if you're talking about, 10, 20, 30, 50, 100 relationships, plus those fintechs / BaaS platforms and customers, it's just a quite different level of complexity for managing things like, KYC, BSA, AML risk, fair lending concerns, which we've seen some action on recently with a FDIC consent order in that space. Yeah, exactly. And so I think the number one area that I think we're seeing that evolution happen right now is, hey, like, it is quite a different thing to say I'm, a 5-branch bank in Oklahoma. I have X customers who are direct customers of my bank. I've done KYC. We do the transaction monitoring, blah, blah, blah ourselves, versus, potentially multiple intermediaries and very different types of clients, customers with potentially different risk profiles than the bank may be used to.
Right.
And so, I mean, certainly there are other areas to think about as well. But that is probably the one that is top of mind.
So it's interesting at Money 2020 in Amsterdam, there was no lack of players. I mean, it's amazing how many organizations you see on the floor that are looking for business in different ways, trying to go to market in different ways. There are so many solutions out there for not only financial service firms, but even the intermediaries. How do you recommend organizations choose a partner? And what have you seen gone wrong as organizations try to digitally transform without maybe sometimes being fully aware of all the aspects that you started just to bring up a minute ago?
Yeah, and I mean, I would point out that this is a relevant question for both sides of those partnerships or those relationships, right? I mean, imagine that you were, a customer of Bond, and now Bond is being acquired by FIS. I mean, is that a good thing? Is it a bad thing? I think it's too early to say. We lack the information. I lack the information to comment on that credibly. But it really is sort of a both sides question of, hey, if I'm a fintech or a non-fintech consumer brand and I want to build a financial product, I want to make sure I'm selecting a partner, whether it's a BaaS platform or directly selecting a bank. I want to make sure that I'm picking a partner where there's clear roles and responsibilities, where due diligence has been done, and where I understand what are the downside risks and how do I mitigate those. I mean, you can imagine if you were a client of Blue Ridge or a client of another partner bank that gets hit with some sort of consent order, even if that doesn't directly impact the program that you're running, it certainly will impact the risk appetite and potentially the sheer capacity of your partner. So, I mean, I think if you're, sort of shopping around and you're the fintech or, non-financial brand building something, you want to sort of do your own due diligence to make sure, hey, is the partner I'm selecting sort of match my risk tolerance, match what it is that I'm trying to do. Vice versa, if you're a bank and you're looking at whether it's middleware platforms or consumer-facing fintech brand, making sure that those, that the economics work, that the incentives are aligned, because I think as this question sort of hints at, we're seeing a lot of risks that were perhaps easier to ignore in 2020, 2021 that are now
early 2023.
Yeah.
I mean,
early 2023 that, as certain aspects of the market have turned are proving, much more difficult to ignore as regulators sort of step up their activity in this area.
Yeah. So let's take a short break here and recognize the sponsors of this podcast. We'd like to thank our sponsor, Microsoft. See how Microsoft can help unlock new opportunities at speed and scale through innovative business processes, delivering differentiated customer experiences across channels, innovating new products and services, and redefining new ways of thinking. Find out more at Microsoft.com/financial services. So welcome back to Banking Transformed. I'm joined today by Jason Mikula, financial advisor, consultant, and publisher of a new study in the state of banking as a service. We've been discussing the transformation of the banking industry and the market potential of banking as a service and embedded banking and embedded finance. So, Jason, we touched upon a little bit before the break, but how do financial institutions need to reimagine their back office to be able to provide a platform that is marketable and is really forward facing?
So, I mean, part of this is just, adapting operational models to work effectively with multiple third-party partners, right? I don't know what your experience working with legal and compliance personnel has been across your career. I can tell you that in, numerous roles I've had, not always the most technologically sophisticated teams, right? And I'm talking very just like minutia of, okay, we're reviewing marketing material, and it consists of emailing PDFs back and forth that would then get marked up, like literally marked up in pen or marker and emailed back. That's not fun when it's inside a single organization, but imagine scaling that to numerous external partners and, increasingly complex things like credit lending models, ensuring fair lending compliance, UDAP, et cetera. So, I mean, I think from an external perspective, so not having been bank side running one of these programs, I would argue that to do so effectively, you really need to have tooling in place, operating models in place to do it in a streamlined, efficient way. And I have to imagine that that's something that not only do you want to be able to demonstrate to potential clients, but also something you need to be able to demonstrate to regulators. It's like, yes, we have line of sight on the risks that our BaaS platform partners are taking, if applicable, that our end fintechs and their clients, customers are taking. And that's not something that a typical existing bank is configured to do.
Yeah, and you've mentioned regulations and compliance a little bit already, but how is the evolving regulations, and it's evolving probably more and faster in the U.S. than anywhere else because they're playing a game of catch up. But how is regulatory environment and government scrutiny really impacting some of these new business models we're talking about?
I mean, the geographic comparison is an interesting one. I mean, between living abroad, living outside of the United States, as well as working with clients, working on projects in a number of different jurisdictions, one of the interesting things, and this is not only true in the U.S., but is that regulators, like any other organization, have a limited amount of resources and tend to prioritize those based on sort of what is either going to have the biggest impact and or what is just sort of demanding the most attention, what is sort of the loudest problem. And I think for quite a long time, banking as a service activities, even if they sort of weren't under that moniker, but some of the stuff we described earlier in the show, relatively niche, a small number of banks involved, relatively small number or small scale number of consumer-facing companies involved. That really got supercharged, over, I would argue, like during the scope of the pandemic, when you saw fintech VC funding, explode for 2 years, 2.5 years, and all of that money flow into fintechs, the majority of which needed a bank partner in some capacity of what they wanted to build and operate. That gave rise to BaaS platforms to solve the pain of integrating with underlying banks. So the argument being speed to market, time to market. And now you're seeing government scrutiny, regulators, legislators catch up and say, oh, hey, this used to be a relatively niche thing with maybe, a dozen banks playing in this space. All of a sudden, 100+ banks want in, rise of the BaaS platforms, which I would, the exact models as far as how they interact with banks and fintechs varies, but adds an extra level of complexity that didn't used to be there, right? I mean, if you were, if you were a Bancorp and you were dealing with a prepaid debit issue, or, not that Bancorp hasn't had issues in the past, because they have, but it was sort of this, one-to-one relalandship versus a one-to-many relationship.
And a relatively clean model, to be honest. It wasn't expanding to areas that have heavy regulation that they're not as aware of. Yeah.
So, I think the impact of what we're seeing unfold now is it is going to serve as a either disincentive, or think about it as like an added cost for banks that want to pursue this business model, right? I think that, based on, bank execs that I've talked with, particularly at smaller banks, I think that there was perhaps a bit of a misunderstanding, misselling that, BaaS, particularly for a bank working with a BaaS platform, could serve as a sort of very easy incremental source of revenue that the bank really wouldn't need to do a lot to realize. And I would argue that was never true. And now we're sort of seeing the consequences of that. Like if you're a bank and you want to do this model, it is doable. I don't think anyone is saying, I don't think any regulators are saying, this needs to go away. It's absolutely not permissible. Like that's not what the conversation is. However, you do need to have adequate systems and adequate staff in place to fulfill your regulatory responsibilities. And all of that adds up to money, right? So how is that likely to play out? Okay, you're always gonna have varying risk appetites across different players. That is already true. But you might see, okay, do we want to work with a brand new fintech that has raised $1 million, $2 million. I think that you're going to see the sort of barriers to entry go up where, for banks that are more risk adverse, they're going to want to see, stronger regulatory compliance staff at the partners they're working with. They're going to want to see better capitalization. Maybe they don't want to work with anybody that's pre-product. Maybe they only want to work with companies that are sort of already operating. So I think the sort of aggregate impact is going to be, somewhat of an increase in friction and expense. And I don't necessarily think that's a bad thing.
Yeah. You look at, we're gonna see consolidation on all sides. We see fintech firms that need funding that aren't going to get it. You see ones that aren't going to ever get scale. Everybody's looking for a partner to make that business model flow better. But as you said, there's no shortcuts. You still have to do all the due diligence, but probably more than ever because the risks are higher. We only have to look at, and the risks are different than they were. You didn't necessarily think, geez, what would happen if the primary bank that was serving a lot of these players went under in a day, and all of a sudden you go, geez, a partner with Silicon Valley Bank is gone. How does that change the model? And how do you have to look at all these partners to go, is everybody okay? Along the same line, and we sometimes forget the people aspect of this because it's very much technology based in the way the platform runs. But there's an increased need for talent and experience that understands the new technologies, but even more so the new models. You're a good example of it. You're in the field regularly helping organizations build better solutions. How does this need actually open the door for broader third-party collaborations with companies that have a broader perspective? Maybe it's the intermediary models. Does this really open the door for more partnerships that way?
I think that's exactly right. If you look at, the largest banks are always going to have the budget and the ability to build a lot of this stuff internally or to acquire, right? We already talked about Fifth Third, we talked about FIS, but for everybody else, the sort of community banks that in some sense have the strongest need for this as their historic business, continues to come under pressure. Obviously, we have like a sort of very temporal risk happening with smaller banks being overly exposed to commercial real estate. We don't need to open that Pandora's box right now. But yeah, if you're a sub 10 billion bank and you're interested in pursuing these models, you may not have the talent in-house. You may not have the ability either from a cost perspective or just a geographic perspective to attract the talent you need to build these kinds of offerings. And so I think that it does help explain the appeal of the BaaS platforms, the middleware platforms to date. And to your point, I think it does open the door for more of these third-party collaborations. And it's not like this is without historical precedent, right? I'm not by any means an expert in the sort of entire life cycle of a mortgage, but that is an example of a product where, maybe 30 or 40 years ago, you went down to Libertyville Bank and Trust, which was like the small local bank where I grew up. And like, you get a mortgage, that bank holds it for the life of that mortgage, services it. If you default, does collections, does foreclosure. Now you've taken that life, that entire life cycle from application, underwriting, origination, servicing, and sliced it up into a million very specialized pieces.
Right.
That doesn't come, without its own problems, as we certainly saw during the pandemic. But it's just a very, very different operating model, including the economics. And I think that is now, we're seeing hints of that in consumer lending, whether it's like credit cards, personal loans, in banking, deposit products. Like, does it work to take some of these products that would have sat in a bank and chop up different pieces of responsibility for operating it, and also obviously going along with that, chopping up some of the economics that go along with that? And I think some of these are fairly well answered, right? The idea of having a non-bank lender that partners with an underlying bank. This is not new, whether it's like credit card, personal loan. I think there are some open questions remaining about, for specific product categories or specific customer segments, is it viable or is it not viable?
Yeah. Finally, we're making these crystal balls shorter and shorter in duration. But if you were to use your crystal ball, what do you see as the biggest area of opportunity and possibly risk in the next 12 to 18 months?
Yeah, I mean, I'm always reluctant to make predictions. I mean, I mentioned commercial real estate in passing. I do think that is a little bit outside of the scope of this conversation, but a problem that we're going to continue to see develop in the coming 12 months. And I mean, to try to link that back to this conversation, smaller community banks tend to have outsized concentration to commercial real estate, both sectorally and also geographically, right? And so, the issues facing that market, post-pandemic, heightened vacancy rates, declining valuations, plus rising interest rate environment. I think that there's quite a bit of risk and uncertainty in how that plays out. I would argue that in a sense that helps make the case, and I think actually Alex wrote something about this in relation to SVB specifically, but it helps make a case for the potential to use banking as a service as a diversification play for smaller banks.
Definitely.
It's like, hey, instead of having, I serve, Nashville and all my customers, both commercial and consumer, are geographically here, versus, hey, like, can I operate on a national scale? So I have geographic diversification. Can I operate across different product categories, different segments?
Just spread my risk.
Yeah, exactly. So I don't know. Hopefully that answered the question.
Oh yeah, it definitely does. Jason, I mentioned your banking as a service state of the marketplace report, which is really, we just scratched the surface in what you discussed there. And actually, any organization that is looking at getting into the banking as a service realm, his report is extraordinarily detailed into what's happened in the past, what organizations are doing, what kind of financial results they've been getting, things of this nature that I think anybody who gets in this space has to read. And it is as current today as it was when it was written just a few months ago. So, Jason, how does somebody get a hold of that report?
Yeah, they can find it on my site at fintechbusinessweekly.com.
Okay, that's simple enough. And again, Jason, I'm a raving fan of the work you're doing, writing regularly, doing podcasts, all the perspectives you give in the marketplace. How do people find you? And I would imagine it's the same way, but how do they follow you?
I mean, they can find the newsletter also, of course, at fintechbusinessweekly.com. I am still on Twitter. We'll see if it's
how that plays out.
That goes before, but it's Mikula JA, which is my last name, and LinkedIn is Jason Mikula.
Great, Jason. I can't believe it's been so long that we waited to get you on the podcast, but we will have you back again because, I enjoy my conversation with you. You always bring new insights that certainly make me smarter, which isn't hard because I have a low bar right now personally. But people mentioned that this Money 2020, how do you keep on top of all this? I said, it's not what I know, it's who I know and what they know, because you just can't keep track of it all. But again, I'm glad you were able to get you on the podcast, and hope everything goes well for you.
Thank you so much, Jim.
Thanks. Thanks for listening to Banking Transformed, the winner of 3 international awards for podcast excellence. If you enjoyed what we're doing, please take some time to give us a positive review on your favorite podcast app. Also, be sure to catch my recent articles in the Financial Brand and the research we're doing for the Digital Banking Report. This has been a production of Evergreen Podcast. A special thank you to our senior producer, Leah Haslage, audio engineer, Sean Rowe-Hoffman, and video producer, Will Pritz. I'm your host, Jim Marous. Remember, banks simply doing business as usual to solve customer problems are at the risk of being left behind.